So before the break, we had a couple of questions from Sandra from Washington. The first question was, how much do I need to have saved before I can get started? Greg, you called for 30% down payment wherever she is. And I would say my question to you is, why 30% and why not the 10, 15% for, say, some of the programs from community banks and other lenders that I'm seeing around the country that are available now?
The reason is that you're going to find a razor thin profit if you're going to find a profit at all. Keep in mind, the smaller your down payment, the bigger your mortgage. The bigger your mortgage, the higher your payment. And so if you're collecting $1,000 a month in rent and you're paying out in your taxes and your insurance and your maintenance reserve and your property management, you're paying out 35 or 40%. But then you've got a mortgage payment that pretty much breaks you even or even less. It's very hard actually to make a profit when you have a mortgage that's at 80 or 90% of the value. Now, I don't know what community banks are doing 10% down, 15% down. Those are very risky loans. And the reason is when a tenant leaves, and sometimes they will, you lose money that month. You have a big payment to make. And if, people can get caught. The point is this. Rushing so that you own the property in a riskier situation because you've got that mortgage and you've got that mortgage payment. So you don't just get a lower payment later on. All right. You have to refinance that mortgage later on, which is going to cost you more money. It's going to eat up your profit for that year just in the closing cost of refinancing the mortgage. So this is why I say get the coffee can, put your Starbucks money in the coffee can, drink the cheap coffee, save as fast as you can, build towards that larger down payment because this is a 25 and 30 year thing. Okay, Sandra was 1 year out of college. That puts her at what, 21 or 22? All right, so she probably wants to retire when she's 50 or 60, right? Mm-hmm. She has 30 to 40 years to work with. Rushing and then having a bad experience in your 20s makes no sense. So go to the planning board meetings. Find out where they're expanding a train, adding a new train station, and there's going to be demand for real estate near that train station. Find where a hospital is adding a wing in your market of choice, and they're going to hire 75 new nurses, and you're going to buy real estate near there. Really scratch under the surface and get to know everything you can about the markets and try to find yourself a gem. They're all over the place. That's the point of this show. We do an hour every week, and it's nonstop niche market reveals of things that are happening that Sandra can go out and find and then know something that very few other people know. And then when she's ready to do it in a really safe way, which is fat down payment, she'll accumulate that property. She'll have a winner. She'll have it well researched. And then she can go on to the next one. And I want her to start thinking about if you want to retire at 50 and you've got 25 plus years to work with, just start in your mind with how many houses you want to have paid off by that time. And if the number is like 20 or 30, it's a great number. You got lots of time to work with. Yep. Lots of time. So just don't give yourself a punch in the gut 3 years from now when you actually have to dump the house or you start going negative on it because you were too hasty.
Take your time, be smart, buy right. And I think the investment strategy she should only be using is buy and hold. It makes sense.
Listen,
I think I think the flipping world, don't get me wrong, you'll see crazy awesome profits every now and then if you can find a deal, but you're putting it on your balance sheet and then you're taking it off. That's not the way to build wealth.
Yeah, and it is the people lose on those situations, and you shouldn't lose in real estate investing. The strategy that we talk about is very sexy in its dependability and predictability, and it's the right way to play this market. Okay, and so applying a short-term strategy to a long-term asset class can sometimes catch you flat-footed and cost you. And so I just don't see any reason to do that. Work hard, make your money over there, make your money in your job, make your money in your business, and then have this be your long-term side hustle that builds you wealth over the long haul.
100%. All right. Smart people saying stupid, dumb things. I feel like there's a lot of these days. I mean, come on. What's your favorite recently?
I hate to say it, Wall Street Journal had an article. The headline, you ready? This is supposed to be good news. Falling mortgage rates, right? Falling mortgage rates raise hopes for battered housing market. Now,
come on. Really? A battered housing market?
45 days ago, the mortgage rates were going up and the world was over. Now the mortgage rates are down, battered housing market. There is no battered housing market. This is, and I believe these people believe this. And so I'm not calling out the reporters because I don't need any mud slung my way by the Wall Street Journal. But I want people to understand that there is a few very, very important assumptions that were made here, and I'm going to call them out in the article. They're talking about the rough patch in the housing market over the last couple of months. The rough patch they're referring to is that the homes are appreciating at a lower rate than they were last year. Okay, so they're still appreciating, just not as much.
But
These
hold
are
on,
the same
Greg, it's not enough appreciation. It's not enough.
9 months earlier, they were terrified of the market crashing because it was appreciating too much, and affordability was low because it was appreciating too much. So the market is working itself into a more steady sort of cadence right now, and so it's very good. So it's not bad or not in the least. All right, if you own real estate around America, your real estate got more valuable during that battered period they're talking about. Okay, they then say something really interesting, which is they're talking about the volatility in the market. But they don't mean the real estate market. They use the word volatility, but what they're talking about, if you read the whole article, is the volatility in the stock market. So the rates are coming down, but with the volatility in the market, it may still be holding some buyers back. All right? There's no volatility in the housing market. Well, the housing market is avoiding volatility by cooling off. The volatility is in the stock market,
That's right.
which, by the way, is actually driving people to the real estate market. Right, I'm part of an organization now with Renters Warehouse. You know, they bought Own America. We were a marketplace platform for buying rental property. We were acquired by the biggest property manager in the country. So now we're doing both sides. We'll help you analyze, research, acquire, and then we'll handle everything going forward. And so the intimidation factor for lots of people is just falling away. Because for a lot of people, it's like, okay, so I bought a property, but now I'm going to get phone calls with the clogged toilet. I'm going to get a tenant who's not going to pay their rent. So this organization is bringing something forth that already, just since we launched this, the leads are coming in droves by people who are saying, I've wanted to invest in the housing market. Now I feel like I can because I don't want to learn that much about it. I don't want to deal with the actual blocking and tackling for the 20 years of property management. And so the volatility is not there. The volatility in the stock market is causing people to want to buy something tangible, to own something tangible. And now the tangible asset, which comes with it some extra work, that's melting away because of these full service, offerings that are being put out there.
Yeah, I don't understand how folks can generally draw a correlation between the stock market and real estate. I've always gotten really confused about this. I'm like, first of all, that doesn't even make any sense to me. And then now you're going to tie volatility in the stock market to less people. The only way that I can see that working is, well, okay, I have stock, it's decreasing in value, I'm going to sell it and use that cash to purchase property, but because I have less cash to invest or less cash to spend, then all of a sudden that's going to deteriorate an already embattled
they're saying
market.
The stock market is going to blow my confidence, and so therefore I'm not going to want to take any risks. And I understand what they're saying, but I think it's having the opposite effect for most people. But check this out. And the reason why I'm being nitpicky is that it's really important for me that people understand the housing market for themselves, that when they read headlines, they immediately distrust the headline, read the article, and bounce it against their common sense. Final paragraph in this says, rising rates choked off a boom in refinancing and dampened the purchase market for much of 2018.
No, that's the worst.
All right. The rates didn't go up until like September. Okay.
Right.
Now that means that the purchasing activity that might have gotten dampened by the rates going up happened in like October, November, and December. That is not much of 2018. That's the end of 2018. We've seen a lot of people. If you do a search of rising rates, housing market, you're going to see people talking about how the housing statistics in September were because of the rates, but they couldn't have been because those houses sold in May. They're out of tempo.